on Sky News Business. This is Trading Day, the close.
Great to have your company as we, of course, ponder. Quite an interesting session on markets today. Rallies, they were in quite thick measure, not least of all in the materials space, where the mining majors, the mid-tiers as well, along for the ride. And actually, as you went down the food chain, you got the outsized upside moves. Quite evidently, the likes of Whitehaven, for instance, about an 8.6% rally. But are these the kind of flurries before, well, the final solution, which is either to team up or perhaps face breakup? This will be a talking point on today's show. We've got Pete McGuire with me, as well as Mark Todd, so we'll be welcoming them properly in just a few moments' time. But let's, of course, without any further ado, perhaps just take a pulse check with both of you gentlemen. Welcome into the programme. You know, there was a lot to ponder. We'll look at these numbers, just animating into them. That's almost 0.9%. It's close, but not quite a cigar. And for once, there was kind of no buckling or blinking. The big four were rising together as one, the mining majors as well. Don't see that often these days.
And I think everyone thought this morning that it would have been not like that. I mean, I think, you know, as I said to you before, I'm in Perth. All you seem to do is get bad news. You assume there's bad news in the markets. And maybe the market's at a point in time where it says, look, these fundamentally are numbers that I could think are sustainable. Now, you know, evidence will prove right or wrong later on. But at the moment, there is a theme around markets where you're saying, how far can this get sold off and what should I do about it? I describe it as risk on regardless of what you are, because cash drives you to risk on. So everyone's risk on. It's either volatility off or risk on, because you can't stay in cash for too long.
Pete?
And that's demonstrated by what came out of Japan, and we're only talking off air, you know, and as far as, you know, negative interest rates and so on. So, yeah, it's, I think that probably the market was a little bit oversold. Markets rebounding as we saw today. I mean, they were probably waiting for that. We all knew that the market had stayed still as far as that RBA announcement. Strong push up, 0.9, not a bad day.
Can we make it, to quickly touch on Japan, just to briefly flirt with the idea of some detail in on this, because on the one hand you've got a nation of savers and a gravitation towards a certain asset class, namely JGBs, right, on that front. But then you have another play running alongside it, which is the Forex story around the yen, which is seen perhaps more as the current account surplus, safe harbour, offshore investment. So
you would have thought there'd be more money coming from Japan to our shores or to other shores, but clearly that hasn't been the case, in that they've just issued JGBs for the first time since ever, since they've been keeping records at negative interest rates. Now, I might be wrong, but it's since my working life, I can't remember. So 10 years at -2 and change. It was oversubscribed. There is one thing around the JGBs you need to be aware of, is that a lot of the big buyers of the JGBs will be the government itself. So there'll be that expanding your own balance sheet. So that's what happens. But what that does do is that risk-on strategy I'm talking about. If you normally bought JGBs, what would you now buy? And Australia looks nice. Across the Pacific, have a look down there. Oh, I remember that place.
And meanwhile, the Fed's yet to get an opinion as to whether that would be a legal move in the United States.
Yeah, there'll be, you know, and I think if Mr. Trump becomes a Republican candidate, the legal move is irrelevant. He'll be out there with themes that will, you know, resonate with a lot of people. It'll be very challenging because he gives you a soundbite answer to a complex issue, and he doesn't like the Fed.
Yep. Very true.
Let's find out whether Andrew Weiner likes the Fed or not. He's got no reason to dislike them, does he? Direct to the desk we go for you now, live via Skype from Toowoomba. Dornbush Partners. Andrew, welcome into the programme. Another day, actually a good payday in many respects. Were you out buying for clients, or was this perhaps one of those sessions on to reflect and just ponder as maybe things got a little bit toppy for their own good? What was all this down to, this buying today?
Yeah, well, good afternoon, Carson, and joining you from sunny Sydney. As opposed
so you are.
As opposed to
my
usual
goodness,
salubrious. But look, it was an interesting day, and again, you know, sort of bouncing around a little bit, but ultimately, I think we're range bound. You know, we're stuck in that 47,000 to 5,000, 4,700 rather to 5,000 mark. We're sort of knocking on what, 49.20, I think, at the moment. So Certainly the RBA not moving, no great surprise there. Good to see a bit of strength in the banks after the beating they took last week. But I think, you know, from a client point of view, well, certainly our clients anyway, there's very little conviction there at the moment. They're just standing there watching and waiting.
Well, you have been, though, adding, I notice the top buy today, Collins Foods, which went through quite the crisis management scenario that a lot of corporates will at some point in time have to grapple with. Seems as if they've emerged from this one, and it looks almost very quaintly like ancient history. What are they now representing? Are they part of this China story? Because they've been associated with it in the wrong way, of course, before today.
Yeah, I mean, I guess it's more just an investment fundamental point of view. I mean, you know, it's, dare I say it, a defensive stock. I mean, certainly it's not something that I would be eating sort of every day, but, you know, equally so, it's sort of comfort food. But on an investment point of view, you know, a PE of 14, 27% earnings growth next year. You know, it's actually looking reasonably attractive. I mean, we sort of started buying it around $2.50, so it's been pretty kind to us so far, but, you know, we're keen to keep adding to it. And really, we're trying to sort of find companies that have got that revenue growth that you're not paying too high a PE for, and it's getting harder and harder out there. You know, we've spoken before about Domino's as an example.
Well, so what about, and we won't even go into the ethical investing side of this discussion, which we could so easily do, just, you know, very, you know, benignly just tread down that pathway. I'm trying to think of my
comfort food strategy.
Well, this is it.
And I really like that, Andrew. I like the comfort food. A bunch of hedge funds are down there eating KFC because the performance of some people who need some comfort. But I wonder if Andrew could comment on the banks. You know, the comment about banks, was there a stabilisation around the view on banks and how they're going to approach markets? Are they prosecuting their story well enough to get your investors to start buying them?
Yeah, it's a really good question because, you know, as we saw last week, as I just said before, they copped an absolute beating. And if you look at sort of a 25-year chart of the ASX financials, banks are actually sitting on a key support level at the moment. So if we continue in that world of pain, it's certainly technically looking pretty ordinary. And I've got clients saying, but, you know, why wouldn't I be buying ANZ or NAB, you know, at 7 to 8% fully franked dividends? And from you know, a yield point of view, on the key premise that they hold those dividends, then they certainly look appealing. But I think you need to sort of look through what's sort of coming up. You know, we've got bank profit reporting season coming at us around late April, early May. You know, is there going to be more bank regulation sort of thrown at us? Who knows what Basel IV might look like? And I think really what the market is saying, it's unsure as to whether more capital is going to be needed to be raised. And if that's the case, will in fact we start seeing sort of some of those dividends being cut? I mean, we saw CBA, despite coming out with a record profit, in fact holding their dividends steady. So it's a bit of a tough one, you know, and the comment was made at the top of the segment around low cash rate forcing clients into equities, or I'm paraphrasing, that was how I took the comment, and that's spot on. But, you know, we've also seen, like with BHP as an example, where, you know, people were expecting the dividend only to halve. But when it got cut by 75%, you know, the market reacted pretty savagely. And so what I'm saying to clients who are looking at banks is, I'm saying, look, I think they look like okay value, but you've got to make a couple of judgment calls. Do you think that unemployment is going to rise? And certainly the commentary out of the RBA would suggest today that they're comfortable with where the labour market is. And do you think there's going to be a concern with housing? And if one or both of those are on your radar as levels of concern, then yeah, you probably should be just holding back on banks at the moment.
All right. And speaking of which, it would be remiss of us not to just dutifully note Catherine Livingstone joining CommBank Board of Directors, replacing Jane Henstridge. That's the news of the hour for you. So very quick turnaround there from Telstra chair back into you know, a board-level position, which no doubt, of course, will be widely welcomed. Your views on that, briefly?
Yeah, look, I agree entirely. I think she's very highly regarded, so certainly good news.
Okay. Listen, we will perhaps leave it there, but thank you as always.
Thank you.
Andrew Weiland there from sunny Sydney. Wonders never cease, don't they? We will have our revolving door upon you for that studio through the rest of the show, incidentally. We'll take a short break, though, returning with my guests, Mark Todd from the NAB, and, of course, Pete McGuire also alongside me. When we come back, though, for you, the Reserve Bank is expected keeping rates on hold at 2% now for the 11th straight month. We'll look at some of its changed language, though, in the statement next. Dust settling on quite a buoyant session today, and that means green on screen in the final washout. Almost 0.9% clear, and contributing to these gains today pretty much a broad array of sectors, but principally coming down to strength in the banking, materials and energy complex. But REITs are standing out nicely as well. Still those expectations overweight that there'll be more chance of easing by the RBA than doing nothing inside 2016. Now, just also noticing some remarks on the wires and then referencing those with a speech that's been submitted to the ASX, at least, so put online by BHP, coming out of Florida, where Andrew Mackenzie, BHP Chief Exec, has been addressing the BMO conference on the 2016 Mining and Metals Conference. BMO Capital, just beginning with some just broad remarks, but again flagging the demerger of South32, which has now come out and had its reports, and of course we know the impairments from last week. Well flagged. Andrew Mackenzie saying, though, in his second paragraph, gentlemen, maybe you might like to talk to this, we are in challenging times, in some senses a new era. Economic uncertainty, extreme volatility, geopolitical instability on top of already well-supplied markets have hurt sentiment, weighed on commodity prices and driven the shares in our sector to decade lows. I mean, that is a wonderful, isn't it? I mean, that captures pretty much everything.
Everything, from Saudi Arabia to BHP to Rios to mining and to oil exploration and wildcatters in the US. So everyone's in the one basket.
Are they right on that basis? And this is something of a face-saving, and also we are to be credited with doing something. Andrew Mackenzie says, look, he said, we foresaw some of these trends. We took a series of early actions which have prepared us well for current conditions and what we believe is a new era. Now, that's at a time when the dividend has just been slashed some 85%.
Exactly.
Do you not see that as awfully ironic? To have almost that failure to even have a mea culpa.
When you look back on 2014 and you saw that there were a lot of headiness and a lot of froth in the markets, we only realised, you know, the price of copper, crude oil and so on. It wasn't, I think, a realisation that there was overcapacity in so many different fronts and there was a correction to be had. I think it washed out far greater than most analysts and most company directors and CEOs thought it would. And now at these sort of levels, it's reconstruct and see if companies are going to survive. Yeah. And if you look back, and we mentioned it last week together, the three of us, Deloitte's numbers, and coming out 33% of the 500 globally traded companies will see probably 34% in bankruptcy this year. So that's a great challenge and a great issue that all of these major players are confronted with.
I think he would reflect that maybe, you know, they would prefer to not have made the dividend story they made 3 years ago. And I think there will be some potentially harsh judgment saying, why did you ever think that you could sustain that? So it's not the fact that they've cut it and therefore it's a tick. How did you implement it? And I think that will be the criticism in hindsight for a lot of those people saying, look, you are what you are. You absorb capital, you buy other businesses, you produce it cheaply, and then you know, grow that business so it goes from $17 to $50. Now, I am mindful of the challenges, but I think they will reflect poorly. People will criticise them for that. So I think it's probably a little bit more under the radar rather than saying we saw this, because when did you see it, in what part of the cycle?
There was a pretty comprehensive attempt to sum up the story of the Brazilian mining disaster on another network last night, and
it was so sad you had to turn it off. Did you see the photos?
Yeah,
it was just unbelievable.
You hear again remarks referenced in this speech, and it's still on the front page, but it just strikes me, in your views here, because this is all to do with, again, some sense of strategy at play or not. Jimmy Wilson's gone as head of iron ore, one of its key pillars. Now, to say, as Andrew Mackenzie said last night, as he repeats here, we have commissioned an external investigation into the cause and will publicly release its findings. To have acted as some kind of an arbiter already on a key divisional head's fate, who was involved inextricably with Samarco.
Yeah.
You can't sort of separate out Jimmy from that, because he sat on the board of Samarco.
Yeah. So when I look at that, I think of two things. One is what sort of agent is BHP? Would I characterise their intent as honourable intent? I do. I think of them as a good corporate citizen.
Ethically driven.
They will make mistakes. I see them as a good corporate citizen. But what it does say to me, how do I value BHP at $16 when things like that can take place? Which there was supposedly a report in 2007 where the mine, the tailings were in stress. How do I understand the core value other than the narrative the company are telling me, which was I'll pay dividends and now I won't? How do I get a sense of, is it value at $16?
So how do you?
I guess you can't.
Right.
I think there's a lot of people who will say that the commodity space is too hard to work out and step away from it until you've got more comfort.
Well, but this is almost like a rerun of 08 then.
Well, in some ways, a rerun of the 90s.
Right.
When you think of what happened from 90 to really 99, and you saw very, very cheap pricing, crude oil averaging $12 to $15 a barrel for a decade, then it turned around. And we all understand that 01, 02, and then all of a sudden the super cycle started. We had the best part of 6 or 7 years, and then all of a sudden the GFC. Well, that played certainly into it. You saw a big collapse as far as NASDAQ and so on, and that all drove as far as capacity. Prices were cheap and plenty of funds went into CapEx spend globally across the world. So now you've got the washout of it, and it's not uncommon to see those big corrections.
The other thing to think about is what he's talking about is demographic shifts. That's what he's talking about. So he is saying that as the world community gets older, what of my resources are they going to use? What product am I going to sell? So when he's talking about a structural change, he's saying, who's building the roads? So if I've taken the private debt of the GFC and put it on the public purse, who's doing the infrastructure? Who's going to do that? So who am I going to sell my product to? And if you look at the politicians of the globe and say...
And what countries?
I'm not sure which ones are going to step up and say, let's have a fiscal engagement. Is it Germany? Absolutely no way. Is it Europe? I don't see it.
I don't think it's Europe. I think it's got to be certainly Asia. It's got to be across that Indian basin, Central Asia, and then rolling across into China.
Get the price?
Well, that's very, very true. I mean, and it adds another line to all of this with Stephen Halmarick, who's coming in on the discussion as well from Colonial First State, with a keen eye on this region, potentially at the expense of others. But the context for all of this being the Reserve Bank, of course, today, its remarks, little change from last month, in fairness, in its justification for doing nothing on rates themselves. The economy, let's face it, domestically hasn't fallen off the proverbial cliff, with Glenn Stevens being again upbeat on future economic growth. He's noted low inflation, moderating house price growth, as well as a strong transition away from mining investments, and made those cases for interest rates to remain low. The labour market, of course, remains in focus, as ever it does, after the unemployment rate itself rose from 5.8% to 6% last month.
Certainly around the labour market data, it's a very difficult case to make near term, and hence they've left their statement wording pretty much unchanged from February, with really a latent easing bias rather than a clear indication of an intention to move. They see inflation as giving them clear scope to move if they choose to do so, but at this stage that labour market, global financial market impact debate doesn't seem to be leaning them in any one direction, though I would agree with your observations around some of the changes in the wording earlier in the government statement. Does seem to have backed away from the stronger wording in February around the labour market conditions, and perhaps there's an element of some wariness about what tomorrow's GDP data may throw up. But all in all, I don't think this was ever going to be a decision statement that gave us a strong indication of anything that's about to happen.
So far, and those are the key words, so far, the economic transition from mining into some other growth driver, exactly, the services economy.
Carson, call it for what it is. It's been outstanding. We have been absolutely outstanding. You think of what the mining world was to us, and then how they've moved into the big centres of Victoria and New South Wales and delivered the service response. Education, farming, the whole response has been absolutely outstanding. So you've got to say, Stephen's done a great job at the currency, if it was Stephen's job at the currency. But the response by the community of our economic community in response, those economic warriors, has been absolutely nothing short of fantastic because of how big the mining piece was.
Well, you've just come back from WA. Now, that, in fairness, that is far from dealing with things in a sanguine way. They're mired in recession. They're going to be stuck like that for how long do you estimate?
Years. They are very worried. They've built infrastructure to places that don't need infrastructure anymore. So I'm talking rail lines to not to nowhere, but if you know what I mean, it's to ports that don't have produce or cannot get to the produce. So I think they are very becoming more conservative about their outcomes. They're just saying, what do I put into my business because I'm not sure who the company is that I'll sell to.
What's the return going to be?
Well,
it's very hard.
You commiserate and you kind of feel in some ways, but it is a world away, but it isn't at the same time. Well, Stephen Halmarick is Head of Economic and Market Research at Colonial First State. As mentioned, he's live in our Sydney CBD studio. Stephen, again, we got a similar kind of theme emerged, did we not, today from the Reserve? That's to say, a domestic story that's glass half full and still the headwinds of the global economy to grapple with. Beyond that, what's on your watch list for the Reserve from here?
Well, I think you're right there in terms of the Reserve Bank commentary. Nothing really changed between the February and the March meeting. The global economy uncertainties are still there. I think we all are very aware of those. But as you've just been discussing with your guests there, I think the domestic economy really has shown much more resilience and much more flexibility than the pessimists gave it credit for late last year and into early this year. So I think the Reserve Bank, like a lot of us, have been fairly pleasantly surprised that the domestic economy is holding up pretty well. And I think we'll see that in the GDP numbers for December quarter out tomorrow. And so our view remains that the cash rate's going to stay at 2% throughout the course of this year.
Is it often, though, Stephen, what's omitted that's also worth pondering as to strategically why did they do that? So if you go back to the last decision, which was, of course, the February one before today, there was reference made to business confidence and conditions. In a positive light, it was flagged. It was absent today's statement, but still intact, the spending part of the business story. What do you take from that?
Well, the business and consumer confidence numbers haven't moved much since the start of the year. And I think what we can say on the kind of, if you like, the other thing that was admitted was the CapEx numbers that came out a week ago. There wasn't much commentary around those, even though they were quite soft. The commentary around the dollar was pretty much what we've been seeing. It continues to adjust.
I suppose what I'm getting at is, are they misrepresenting? In their admissions, are they actually running the risk of misrepresenting the story in its entirety?
I don't think so, but I think we need to keep in mind that I think the goal with today's statement and the statement after most board meetings where they don't do anything is just to get their view across in a very short space of time. And then you look at the statement of monetary policies that come out every quarter, the minutes, speeches by senior Reserve Bank people for more flesh on the bone, if you like. So I think the goal for today's statement was, not to leave things out deliberately to, if you like, to direct attention, but just to get the fact down. Well, we've done nothing for February, we've done nothing for March. Things are going along pretty well. The bias, if anything, is to ease, but at the moment we're pretty happy. Let's get that view down in the shortest number of words as possible, and we can all move on. It
just seemed extraordinary because we were talking about negative rates in Japan and a real sense of fervour to some central banks right now, and we're facing those dynamics. We're an ageing population like the Japanese. Do you see again some kind of a similarity at play there, Pete? I mean,
we've got as far as Japan's concerned, their zero population growth. They've got certainly an ageing population, but they don't have the same as far as babies of what Australia has. So our birth rate is proportionally far higher than what Japan's is. We've got a far smaller population. We've got a differing, demographic as well, and I think we're far younger as far as a total versus Japan.
Oh, ever. Yeah. Just a question for Stephen. I'm curious about how you imagine the central banks will be looking at these challenges. So, in other words, I'd like to know what you thought the RBA thought when Japan, a week after saying they would not go to negative rates, went to minus 10 basis points for excess cash. Do you think that sent a shiver through the various central banks? And if so, how do you think Australia looked at itself as a country with, wow, we now become very high?
My view is that the move to a negative interest rates from the BOJ, which was a bit over a month ago now, 29th of January, was quite a bit of a game changer for global central banks. I think not just the fact that they moved to negative on that day, as you say, for some of the excess reserves, but the statement was very clear from Governor Kuroda that once you go into negative, they look like they're more than happy to keep going, to have rates quite deeply negative. I wouldn't be surprised if we're at minus 50 basis points or even towards minus 1% later this year or early next year from the BOJ. Now, and I also expect the ECB to cut rates further into negative when they meet on the 10th of March, from minus 30 basis points maybe to minus 50. Now, the big question that everyone's asking me, including some of my colleagues this morning, is will that make any difference to their economy? The yen has rallied since the BOJ moved interest rates into negative territory.
Different reason, right?
Really
you'd acknowledge there are different factors that are at play that drive the yen moves, not least of all, a perception on current account surplus a la Europe as well. Hence,
very much so. Yeah. So the global flight to quality has been to the current account surplus countries, to Japan and Europe, irrespective of their negative interest rates. And the Aussie dollar, it's traded up a little bit since then, but not dramatically so. So I think from the Reserve Bank of Australia's point of view, if they were to see rates move deeply negative further in Japan and Europe, and those currencies, their currencies depreciate, so the Aussie dollar's heading towards 75, 76 cents, I think then the RBA would be worried and they would start thinking about cutting rates here again. But with the Aussie dollar 71, 72 for quite a number of weeks now, I think they're comfortable to leave it. So that move to negative interest rates, I think, really would have got the RBA's attention, but the currency is the critical factor here. If the currency appreciates for no other reason than the fact that we've got a widening interest rate spread with some of our major trading partners, I think the RBA would be onto that with another rate cut, but at the moment the currency is behaving relatively steady.
So, Stephen, a follow-up question. In regards to that strategy that all the central banks are now sort of moving towards, which is lowering rates and going to negative, I often think, when I talk to customers, they say, well, I want a 90-day TD, and I look at their investment strategy. Is it hard, do you think, to get people to understand if you like, the trajectory of this stuff? If the RBA looks at Japan going to negative, it's not like they'll go to negative for a week or even a year. It's like the ramifications are for years, not just the next smaller 3-month cycle. It's literally trying to get customers to realise that the risk-on strategy that I was talking about before is on the basis that rates are going so low and will be here for absolutely 4 years.
Yes, very much so. You've just described the biggest challenge in my day-to-day work, which is explaining how negative interest rates work, or how are they supposed to work. What do they imply for investment decisions? That's a discussion that we have to have with our clients, and as you say, you are having with yours, whether it's retail or institutional, right across the spectrum. And we're doing a significant amount of work on that. How does negative interest rates affect the banking system? How does it get transmitted from the central bank through the banking system to the real economy? Can banks charge their customers a negative interest rate for a term deposit? Can they, will they, should they? These are issues that really, I think, markets are very, very uncertain about, hence the big increase in volatility and downdrafts in equities.
It's worse, Stephen. How are you set up for your mortgage? If you go negative mortgage rates, the bank will pay you, and they're doing that in Europe now, the bank will pay you to take some money out. I mean, there's...
Not on that part of the book, surely.
No. It's just how do you charge? How do you... if you are linked to a floating rate note, if you're linked to a floating rate note and that note goes lower, so if your mortgage is linked to BBSW and BBSW goes to negative numbers and you're in Japan, all of a sudden the bank says, how do I do this? How do you what account do I send this to? It's just...
Okay. The big elephant in the room, because that's got a big question mark that's still going to be rotating around this table like some kind of a growing... exactly. But, Stephen, just before we lose you, a thought too, and it shot out of the mouth of Ashraf Lighty, the strategist, in the wake of the BOJ move. He said the Fed's next on negative rates. So who would have thought? I mean, Janet said in December, we've got to reverse gear. It was almost said in passing, but it was noted. Do you see that as any kind of an eventuality on this? Because, I mean, if decoupling's dead, it seems inevitable.
I think the Fed is still very much of the mind that the next move in interest rates is up. I don't think we'll get that in March. I think we'll get the next rate hike from the Fed in June, and we'll get 2 this year. But I think at the March FOMC meeting, if they look at their mandate, so their mandate is full employment and price stability. The unemployment rate's now down to 4.8%, and core PCE popped up from 1.4 to 1.7 in the reading late last week. So on their mandate numbers, they're saying we need to put interest rates up. They are, no doubt, well, Janet Yellen has said they are looking at negative interest rates. Do they have the legal authority to do that? Would they do that in if you like, in a moral sense and an economic sense? So they're doing a lot of work to study whether that is required. You could imagine at some stage in the future that negative interest rates will be within the toolkit that the Federal Reserve contemplates, but I don't think we should be thinking about that this year. In fact, I still think the next move in interest rates in the US is up.
Okay. Well, Stephen, we'll need to get through March, as you've said. Some more non-farms numbers, and then I'll come out the other end of it. But thank you so much. Appreciate it.
My pleasure. Thanks, everybody.
Thank you.
You could, I mean, this discussion could go so much broader as well as to say, well, when there was beginning of QE, it should have come with strings attached. It should have said where that money could and couldn't go. But that's another discussion. When we come back after the break, Slater and Gordon, you won't believe it, but the price target has again been slashed by some 34%. Find out the broker that did it after this break. Australian businesses are taking somewhat of a dim view of what's ahead for the next quarter. Their confidence weighed by market volatility as well as that looming federal election. This is the Dun & Bradstreet Business Expectations Survey. It's found essentially businesses tip sales, profits, employment as well as capex to fall in the final quarter of the financial year. Expectations for all those areas are now running at their lowest levels in about 2 years. On the profit side of the ledger, things expected to be coming in at their lowest point since 2012. Sales and employment forecasts also on the back foot. The services sector, for its part, downbeat, predicting sales more than halving in the 3 months to June. That is one ugly release. The deficit, meanwhile, has widened to, well, there was not one good metric that I could count in that roll call. Well, meanwhile, the deficit has widened. It's blown out to 21.1 billion, just for those of you interested in the points that accompany these releases. This is the December quarter figure we're talking here. Another 3 billion more than in the previous 3 months. So pretty pickle if your surname is Morrison and you're going to be standing up. It's
unusual. What you've just described is as if the RBA hasn't read that.
Well, this is the thing.
It's completely at crosshairs, and it doesn't seem, that seems to be, what is that? Why does corporate Australia think differently from what the RBA, what data are they looking at? And is it one of, we are getting more conservative? There is something clearly wrong in the messaging. Well,
and in fairness, it's come up before. They've talked about equity market performance being running pretty much along global averages. That found its way into the statement, whether it was February's statement, I believe it was, and somehow we were looking at that at the time. So let's go down to the dealing room at CMC Markets on that measure. Rick's with us, Rick Spooner, joining the discussion. Rick, just to mull that briefly, your thoughts about access to data, the sets that the RBA scrutinises, the ones that we pull apart. Somehow there seems to be a little bit of a mismatch running.
I guess there does, Carson. I think actually one of the dangers in our profession is getting a bit too close to all this and not seeing the wood for the trees. You know, I think, for example, you know, I heard people today criticising the RBA statement. They could have said this, they could have said that. I have a view that some central banks, particularly the Fed, says far too much. For example, you know, not only is it tedious reading their minutes, but I really question how much benefit and how much it adds to get the sort of details of the to and fro in a two-day meeting, and some people said this, some people said that, and that sort of thing. I think really, at the end of the day, of course, central banks' job is to set rates and to help stabilise the economy, and as part of that they try to give us a sort of a bit of a broad brush about what they're thinking.
Well, okay, just on that measure though, because you make a very clear point, Rick, but I'm intrigued to know how you then justify having what you say to be a representative snapshot of Australia sitting on the board when, you know, at best we might hear from one of them, say once every 4 months, if you're lucky. So go to the other extreme, and then on a statement today where perhaps there were 3 words changed on month. Now, was that really, justifying, the setup that they occupy there? For one, I mean, it seems awfully light on, does it not?
Well, no, I actually disagree. Firstly, I don't think that the RBA board is intended to be, nor is it a snapshot of the population. They're not politicians. It's a board of, I think, 8 or 10, is it? People who, have expertise in setting rates. As part of that, we do have a business representative.
Yeah. Well, what's their expertise in setting rates from that vantage point? Where do they get that expertise from?
I think to some extent, to butt in for an answer, is they're supposed to represent business and banking and a broad cross-section of the community. And I guess I'm still trying to understand why their interpretation, and maybe it's just a cautiousness that's emanating everywhere. When you see a lot of bad news, which you do, at the moment, you see, just think of Donald Trump. If you think of the impact on the US economy, what do you think would happen if you were selling product into the US in an election year like we're having now?
Exactly.
Would you be confident that you were going to sell CSL product and saying it's all fine, or are you seeing from your customers the impact of the divergence of policy, and we've got really low interest rates in the US, and yet we feel bad about it? And it's that combination. It's just clearly business is reacting very quickly to.
And you've got the Dow at 16,000, so it's kind of like, hello, reality check.
It's the risk on, right? Cash rates at 0. Where am I going to put money? If I couldn't get the 4% dividend, I'd go elsewhere. But how do I get my members, my whoever, my funders, the return they want? I borrow as cheaply as I can. I buy at 4%, and hopefully the music doesn't turn off. Exactly. This is the biggest financial musical chairs you've ever going to see in your life.
Well, I thought we'd even been there before and concluded it was ugly.
This is the main game. This is the one.
Rick, add some...
That was a warm-up.
That was a warm-up. Pete McGuire says, Rick, what's your perspective?
I'm sorry, Carson, I missed that.
Well, I'm just saying, Pete's saying this was a warm-up. If you thought this was musical chairs and Emperor Has No Clothes combined, you ain't seen nothing yet.
Well, look, I guess I might have a bit of a contrary view here. I think just looking at us, one thing is about the post-GFC period and all economic downturns when you see a lot of surplus like we have at the moment, is that things happen much more slowly as far as economies are concerned. We're in a slow-moving phase. But look, on a 2-year view of things, I think, a forward-looking view, 1 or 2 things is going to happen here. Either the Fed is going to basically lead the world out of quantitative easing, or alternatively, the ECB and Bank of Japan are going to suck us all back further into it. Now, I think the former is more likely. I'm sure there'll be lots of down there and dirty and, toing and froing over the next few months. But basically, that US domestic economy is pretty strong. And as I heard Stephen Halmarek say before this cross, the core PCE is now up to 1.7%. Now, that's about the domestic economy. That's about rents, airfares, medical costs. And that's happening despite the stronger US dollar. So very gradually, I think that the Fed will lift rates, and that will take pressure off the BOJ and ECB.
One thing,
and I suspect that rates in Australia are not going to get any lower than they are now. The next move will be up, I think.
And one thing, incidentally, that no one ever talks about as part of that is normalising the balance sheet of the Fed. So, number one, we've never let ourselves out of a program of this magnitude. We're talking about balance sheet expansion of $5 trillion plus, no precedent, and then normalisation. Where do you start, Mark?
Yeah, I don't think I'd agree with Rick in respect of the US leading anyone out, really. only because at some point in time your trading partners stop trading, so that you are limited by your counterparts.
Exactly.
You've got the self-combustion,
right.
and then all of a sudden over time, because your currency, you can't go too much further. So they have to lift with it. Maybe Rick's right. Maybe they'll be able to drag them up, but I'm unsure that that's going to happen. But what it does do is the performance of the US has meant that the tax receipts are better than had been anticipated. So the Fed keeps buying its own treasuries, but over time it starts issuing less. It needs less money. They're making money as a country, so time is solving their wounds. It's not solving the wounds for the rest of the world because they're not making enough tax. But the US is definitely making enough tax.
Unemployment's down, less support.
That's the
well, is there less support? Because unemployment, you know, if the job no longer exists, of course unemployment will be down in a sense, but you've mechanised the process, right? Do you see it as simply that the US has become very good at job creation suddenly out of nothing, or it's just become more productive?
I don't think out of nothing. I think innovation, and certainly, you know, where the US was in the early 00s, it was technology driven. Certainly a lot of those jobs have now come into play, and that an ever-changing landscape. A 16-year-old has a different perception of where they'll be employed than a 26 or a 36-year-old. So they're seeing technology as where the lifeblood of what's moving forward.
What a wealthy nation, though, is it? I mean, the average hourly rates in the United States are a pittance.
It's wealthy for some. That's definitely the case. So the thing about the US, the way to think about US is that it reboots itself as it sees fit. So I looked at some data points. There's a thing called Baker Hughes recount that I've spoken about before. Yep. It's down to 430. It was at about 1950 2 years ago. Yep. As the oil price goes down, they just close these things up, and the people who work on them go and find another job. And people believe in the American dream, and so that sustains this narrative that you lose your job and you physically reboot yourself as well and go and get another one. And so, though there's a disgruntled attitude, which is then fed into the Trump presidency, but the reality is that's the US. There's no net in the same way there is in Europe.
But, I mean, this is the whole point, is it not, that he's confounded the punters, and I know I'm kind of bringing it back into the politics, but it's precisely because you have now a critical voting mass that have said over all these years what was meant to be a trickle-down is not trickled down at all. And we want someone who will articulate that and will break the cycle of just perpetual lobbyists feeding on the minority versus the majority view.
Yeah, so a question for Rick maybe is in terms of your customers, that whole story about buy into the US rally, are they still trying to do that, or are they looking at this political year really coming quite quickly home to roost and going, hang on a second, I'm not 100% certain who's the beneficiary of the volatility in the politics?
Well, I think a bit of both. Probably that's a sensible position, Mark, you know, because I think the US economy is doing okay, in the sense a bit better than others, and so it is one place where there are some reasonable things happening. But there's absolutely, I think, if you look at a lot of the risks that we have in the world, including the central bank risks, fundamentally a lot of them boil back down to politics. I mean, the central bank risk is largely a function of the fact that the politicians are not doing much. We live in a populist age. And to answer your question directly, I mean, I think the US presidential election looks like a very clear and present market risk at this stage. We'll have to see how things are going, but none of the major candidates have what look to me like in any way market-friendly policies, let alone probably economic-friendly policies. For example, I mean, a clear and consistent theme amongst all of them is protectionism. You know, we definitely seem to be going backwards in that regard. So there are risks, but let's hope sense prevails, I guess, is the client-fair attitude.
Okay. We are unfortunately out of time, but just before we lose you, so a really brief thought. Slater and Gordon, you can't ignore today the fact that, again, it's just been such a huge disappointment. 45.6%. Week at a new yearly low of 31.5 cents. Rick, and a broker that's just basically said, get out and stop pretending.
Well, that seems right, Carson. I mean, obviously the price of telling us the story, the company's survival is in question. One of the unfortunate things about getting into this situation is that, of course, it starts to feed very much on your customer base, I would think, particularly for a services company. I mean, am I going to do business with a company where I'm concerned about whether
their survival,
their staff's going to still be there? I think we're in that situation now.
All right. That was nicely sort of summed up in a nice brief way. Rick, thank you. We've run run that conversation. We'll talk with Rick again into the coming days, but we'll take a break. When we come back, S&P out and taking BHP away from that credit watch position. So in a sense, a fresh development from the rating agency's view. We'll dive into it after this.
Live on Sky News Business, this is Trading Day, the close.
Hello and welcome if you just joined us. We are into the second hour of play for you today. It's been a busy first 60 minutes with my guest hosts, Pete McGuire, CEO of xm.com/au, and on my other side, of course, Mark Todd from the NAB. Lots to discuss. A currency watch coming up for you. Robert Rennie from Westpac Institutional joining the discussion. Let's, of course, speaking of currencies, ponder what's happened in the last few hours. It was another no change as expected decision by the Reserve, 71.39 there against the greenback, and just easing back against the rest of the basket in the event. We've got non-farms to come out of the US, rounding out the week. Always a critical swing factor on risk, and with it, the fortunes of the local unit. But let's, for now, turn our attention to what's going on in China. PBOC, for its part, out today, cutting the amount of money banks have to hold in reserve. It's ramping up efforts to lower funding costs, try and boost the economy that way. PBOC saying it'll lower the reserve requirement ratio, the RRR, by some 0.5% to take it to 17% towards China's biggest lenders. The move expected to free up about 700 billion yuan in funds for banks to make loans. Sounds like a wonderfully buoyant number, doesn't it? Well, analysts say indeed it marks a sharp reversal, though, in PBOC's stance. It resisted using aggressive easing tools in recent months, fearing it could add pressure to the weakening yuan. Thoughts? Well,
remember the problem with China has always been what's happening in this shadow economy.
Exactly.
So the money is being lent by organisations that aren't the banks, and so everyone was worried about the black shadow economy. And now we don't hear so much about the shadow economy. We hear more about the banks looking to lend. It's one of those challenges where you say, is that the problem? And I think to some extent, the conundrum for China is what policy works in an economy that's growing and evolving in the way it is, that you are learning policies, triggers that make the economy work. So if you think of the US, been going for hundreds of years, they know the lever to work. US
you hope they would, but that's ironic.
But
you're right, okay.
They do. They
believe in them.
They broadly know.
Yes.
China, it's evolving.
Exactly.
Remember, China said, go and buy the equity market. And they said, if you don't buy the equity market, you're cowards. Put all those notes out. And the equity market got smashed. So they lent the money into the finance houses and said, lend them so they have leverage. They didn't borrow. So they're looking at their people saying, how do I stimulate? And it's all new policies.
And that's potentially, and let's bring in Robert Rennie from Westpac Institutional on this one. Robert, welcome into the show. This perhaps in part, the answer from the guest from the panel explains why we didn't get a coordinated G20 response, because quite simply, there's no such thing as coordination possible right now. Is that a valid comment?
Yeah, look, I think that is a very fair point. You know, one of the key takeaways from G20 was certainly, at least from a major central bank point of view, that we seem to be reaching the limits of monetary policy. I think there's not too much that we can expect. But I do think on the part of China, there is still plenty of room for further monetary policy. You mentioned the RRR level. You're looking at about 17%. One-year lending rates, at least in a real sense, are high. So I think China's one of those economies where we can probably expect to see more. And I think the developments last night came at an interesting time. It's just ahead of the National People's Congress. It's just post G20. And the PBOC recently did talk about introducing easier monetary policy. So it's interesting to see the moves come as quickly as they have. And obviously today's disappointing PMI data probably does suggest that there's more to come.
Now, do you get a sense that they're even backing the right sectors of growth the right growth drivers at this point in time, or are they heading back into pretty predictable territory? It's important to, in other words, back a winner and not a dud, and get a sort of a loan that was meant in good faith come back as a non-performing one, bite you big time. How are they doing that process? How's that changed?
Look, certainly from my point of view, I think there is an element of shotgun approach going on just now. Clearly, parts of the domestic economy, and you can see it within the services PMI, it does feel as if the situation is improving. But one thing I did find disappointing today was the ongoing weakness in the employment subsets of PMI. That's something that we saw in the recent Westpac MNI China Consumer Sentiment Index. And if the consumer is worried about his and her jobs, it's really going to be difficult to stimulate the Chinese economy. So again, I think probably what we're doing is we're throwing a little bit of policy at everything, and we hope it sticks. And obviously, as we move through National People's Congress over the next week, it may be the case that we see further fiscal policy announced as well.
Robert, Mark Todd here from the NAB. The commentary coming out of the G20 around the currency strategies of the various countries suggests that they all agreed to, let's say, put their head in the sand or choose to say there's no currency war at foot, and particularly with respect to China. Was it just diplomacy at foot, do you think, or is there really a change around their attitude towards the different currency battles that take place? It seemed to be the only tool the various central banks have got to try and stimulate their economy.
Yeah, look, I think you raise a very good point. Is it just a case of we'll agree to disagree and we'll not talk about it publicly, or are we actually seeing a shift in policy? Look, I think the only logical way of answering that question is really to argue, well, let's see what happens in coming weeks. Certainly next week, I would expect the ECB to cut further negative deposit rates. I would also expect to see an increase in QE from the ECB as well. And I think as we move through April, we'll probably expect to see more from the BOJ. I think the key, though, is that if you're out there and you're really targeting the currency as the key mechanism that you really want to sort of translate monetary policy into economic activity, that's been taken off the agenda. Let's not go to that area. And obviously, as the BOJ found at the very end of January, if you try and target the currency, sometimes you have unintended consequences. And obviously, the rapid appreciation that we saw in the yen post that move from the BOJ certainly was unintended, wasn't it?
It was. Well, so therefore, you've just mentioned ECB, Bank of Japan. March you've got the US Fed.
Correct.
That must be the most interesting. I guess the scriptwriter's already starting to write it. They're trying to pen that strategy around our economy is really strong. We'll watch the rest of the world. We can't move on rates. Could you write it now and deliver to them? Is that the sort of? It's already been worked out, do you think?
Yeah, look, I certainly think so. Again, you look at last night's CPI out of Europe, France, Germany, Italy, and I think Spain all saw negative inflation rates. The Bundesbank mid last month downward revised their forecast for inflation for this year from 1% to 0.25%. So the fundamental drivers really for inflation are quietly withering away. I would expect to see on the 10th of March the ECB cutting fairly aggressively its forecasts for CPI this year. That opens the door to further monetary policy, and this divergence that we're talking about here will continue. So look, I think that continues to drive a weaker euro, and I wouldn't be surprised to see euro continuing to push lower, somewhere between 106 and 108 mid next week.
You say, in retrospect, a lot came down to, in terms of the way the RBA characterised the moves in the dollar, a lot came down really to the Friday finish, the way it was handled, and the way it was capped more precisely at what, just on 72.50. So is that sort of the comfort band that we should now adjust to? The reserve, realistically speaking, if it's hovering around that level, don't expect any real appetite to go out on the front foot.
Yeah, look, I think so. Somewhere in that 70-73. In August of last year, the RBA stepped back from using the terminal terminology, further depreciation or further weakness both likely and necessary, to the is adjusting terminology, and we've had that really delivered since then. The levels that we were looking at back in August of last year were round about the 72.80 to 73 mark. So, you know, from my point of view, anything really north of 72.75, 73 is probably a level that the RBA is beginning to feel uncomfortable about. Yeah. And if we're in the zone, 70, 73, well, it's adjusting to economic fundamentals.
And Robert, what are the clients doing? If, in terms of that strategy, this is, you know, basically no man's land. Don't get me wrong, I'm not saying the strategy's bad. I'm saying the rate at the moment is in that no man's land where it's hard to put on a very short position or go long. So what does that mean the clients are doing? Have they got very rigid bands? They say if it gets down to 70, I'm a buyer. At 75, I'm a seller. Or is it we are just looking at the world saying it's so volatile we don't know what to do?
Look, I think we're probably looking elsewhere, to be perfectly honest. You know, we've got interesting developments in the UK at the moment with Cameron a couple of weekends ago getting the agreement that he wanted from Europe and moving to a referendum in the UK on the 23rd of June. That's put sterling very much on the front foot. You know, the recent deterioration in the inflation outlook in Europe, very much the same. I think the Australian dollar and to an extent other commodity currencies, at least in the moment, are probably in the too hard basket. Remember, in the background, though, we're beginning to see slightly better price action in some commodities. In the last couple of days, West Texas crude has been 3%. Trading up to 35, 36. Copper on Friday night even traded as high as 47.50. We haven't seen 47.50 in copper since, what, mid-November last year. Yeah. So the underlying fundamentals, you know, from a commodity point of view are actually improving. And I think that's one of the things that's maybe forcing customers just to step back a bit. You know, if the Australian dollar is adjusting to weaker commodity prices, what happens if the outlook for commodity prices suddenly starts to improve?
Well, exactly right, and you may see, you know, the 74, 75s. Certainly in the retail sector, Rob, you're seeing big trading ranges and certainly whipsaw actions and plenty of activity there from traders short and long. I think that will remain going forward over the next couple of months. I don't see any back off from a retail side, and there seems to be a lot of momentum there, not only from the commodity trading currencies, but certainly the yen, very much on the euro, and it's going to be interesting leading up, of course, to what happens with the US.
Look, absolutely. You know, and I think that story really does continue. We had a couple of our strategy up in Japan through last week, and we were up there basically sort of testing the level of demand. Remember, we're seeing negative deposit rates being forced on the Japanese retail investor, and the Japanese retail investor doesn't like negative deposit rates. We definitely detected a bit of a shift in terms of sentiment, this time more than many other trips that we've had over the last couple of years. So I think when you look at it from a retail point of view, in a world where we're potential further cuts to negative deposit rates in Europe, potentially more from the BOJ in April, you know, I think we're still going to be talking about ongoing global retail demand for higher yielding currencies like the Australian dollar.
Well, exactly, and I think Mrs. Watanabe, she'll certainly be very focused as far as, you know, carry trades and so on. So absolutely. I see that their appetite is only going to increase as the year wears on.
But Rob, I think that's right, but what are they going to buy? That's the key, because are they going to buy Australian government bonds, semi-government bonds? Is that all they're going to buy, or are they going to buy Westpac credit? Or are you saying they might actually buy Westpac equity? Look,
I think it's probably a combination of all of the above. One of the key questions that we were asking is, you know, what is high yield to the average Japanese investor? Now, clearly, although it feels strange, US dollar, US treasuries are high-yielding bonds from that point of view. So, you know, what sort of environment do you have to see to really be comfortable that Australia and the US should be sort of put in the same basket? The answer that we got back was, well, we've got to see the right level of Aussie yen. And clearly the recent dips in volatility that we've had down towards the 80-82 level, that certainly feels like it's getting to attractive levels. So as long as we're AAA, as long as we're seen as you know, politically secure, etc., and the yields are there, the currency's at the right level, I'm sure the demand is going to follow.
Well, as long as we keep paying the ratings agencies, we should be all right. To be fairly prestigious. Robert, thank you so much. Appreciate it.
Many thanks.
yes, it does warrant that kind of cast off, because it was rather facetious. So I'm head of macro strategy at Westpac Institutional Bank there, Robert Rennie. Always a pleasure to have him with us. When we come back, we'll go to Bloomberg HQ in Asia, to Hong Kong specifically, therefore, where markets are really ticking over in a good way today, and the comp as well, leading that charge higher. More in a minute. Welcome back to you. As promised, we're taking you live to Bloomberg in Hong Kong, checking in with David Ingalls. David, welcome. The Kospi, well, if it was indeed trading today, it was the one to let the side down. It tripped up a little bit, but otherwise it was a sea of green. Based on what?
Well, first, based on, I guess, we saw declines yesterday. When we went into this morning, we didn't really have a lot of bad news. In fact, when Asia went to bed, when we went to bed, of course, the last big piece of news there was China cutting its RRR. Now, I think that's a bit tricky, because when we did get up this morning, we looked at losses on Wall Street. It was a bit of a tug of war in the morning session here, and we're just entering the last part of trade across the region, because on one hand, you had the strong Japanese yen for the most part of the day. So that basically capped any gains that we saw in Japan, and that basically also capped any gains that we saw on the regional benchmark, of which Japan is very heavily weighted. But everywhere else, though, we were looking at gains. Now, I think what's changed, though, in the last maybe 30 minutes to the last hour or so, is that you had a few bits and pieces of good news coming out. You had Macau coming out with their gaming revenue for February. It didn't fall as much. In fact, it was just flat for the first time since I can remember, first time maybe in over a year. The Japanese yen started to weaken for the first time, I guess, today, and that helped lift Japanese equities all the way up until the finish. We're just closing up shop there in Tokyo. Plus, of course, the big news was really in Japan. I mean, forget China for the moment. Shinzo Abe was just speaking in Parliament a few hours ago, well, about 90 minutes ago. He basically came out and clarified the policy objectives of the BOJ, similar to what we heard on the weekend at the G20, where the objective is really getting Japan out of deflation and not so much targeting a weaker exchange rate. Now, consequently, perhaps because of that, or as a result of that, we saw Japanese bond yields continue to fall. So especially the longer end of the curve, there was a lot of money going in. There was a lot of buying. It also so happened that Japan had an auction today, 10-year bonds. And, well, it was official. For the first time on record, Japan basically sold 10-year bonds with a negative yield. In other words, people are now paying money to Japan to keep their money for them. So that pushed yields lower. And that's where we are at the moment. We're looking at gains across equity markets. We're looking at gains across the bond markets. There's not a lot of volume involved, though. And, of course, you do have to consider all these PMI data which came out of China. Not so good, though. But, again, the backdrop, I guess, of the Chinese central bank prepared now, perhaps, to support liquidity. Not so much the economy, but liquidity in the markets at this point.
And just in regard to that Bank of Japan and the negative rates, was the coverage quite a lot? In other words, were there a lot of buyers for that new issue? And is there a lot of follow-through buying at the moment in the Japanese Bank of Japan bonds?
Well, okay. Well, the bid-call ratio, I guess in that sense, was not bad. But I guess to your second question, I think that was the more important one. We were looking at the bond yields now from the 10-year, which touched a record low just a few minutes back. I think we're a little bit above that. But the 15-year, the 20-year, the 30, and the 40-year Japanese government, or in other words, the long part of the yield curve, are now at record low. So there's been certainly a downward shift in the yield curve in Japan if you compare it to, say, 2 weeks ago. So there is some follow-through buying. We were talking to some people here earlier. Obviously, it doesn't make sense for you to actually lend the money to Japan so they can keep your money for you. But that's if, obviously, just to make it simple, you believe that yields are going to go lower. And just based on what we've seen so far, it does seem that people do believe that these yields can grind lower and lower. So that's it for the moment. Whether it makes sense or not, that's what's happening here.
Well, if they believed it because Kuroda said it, then I would be worried. Or would you not be worried? Because he's now developing a record for sake. He's basically acknowledged they could go, more steeply into negative territory. But then again, he was denying this program had even been dreamt up. and then announced it. So how consistent do you take him then to say that they will go even, potentially weaker still from where they're currently sitting at? And what will be the trigger for that?
And what will be the number, say, by September?
Well, I mean, okay, so you look, I guess, at where the yen is trading at the moment. I mean, he's obviously come out and said he's ready to do anything that he needs to do to get inflation up and running. Now, it depends on what gauge of inflation you look at. We just got one a few days ago, which was basically flat. And we're, I guess, halfway, if you want to look at that, the ex-energy, ex-fresh food gauge, we're halfway to his target. Now, do you want to second-guess the BOJ? Yes, we are in uncharted territory, if you will, when you look at negative yields. But, I mean, they don't call this trade the Widowmaker for nothing. I mean, people have called for a rise in yields for several years now. You look at the debt load in Japan, it doesn't make sense why these yields are coming lower and lower. But you also have to acknowledge that everywhere else in the world, there's a risk-off sentiment. Even Shinzo Abe mentioned that when he was speaking in Parliament earlier. I spoke about that when he said, yes, this global risk-off sentiment is really hitting markets at the moment. Whether you believe markets are overshooting to the downside or not, it doesn't matter at the moment. Yields are grinding lower, and there's a lot of money flowing into Japan, whether that's just into Japanese government bonds or the Japanese yen, which is still at the 112s, 113s against the US dollar.
The irony of the debt load that you just mentioned is that they actually last month made $450 million on the negative yields. So they're actually making money to pay off their own debt by borrowing money. There must be some sort of movie about this. If this isn't The Big Short, nothing is.
There was
and it is a Widowmaker. Well, it is. No one can short. No one, as an expat, who goes up there and shorts the Japanese curve because everyone that went before them are now dead.
We're about to lose the line on that salutary note. Thank you, David Ingles.
Put it into some sort of context. We've seen the Nikkei down this part of 23, 24% this year from its highs. But still, when you put your mind back to the start of 13, we were at 8,000 odd points. We're now at 16,000. So it's had a very, very solid uptick. Huge, big numbers, nearly to 21,000, and certainly now at 16,000. But a lot stronger than when you put your mind back to the 11s and 12s and 13s.
And you have to say that pick-up in the VIX, which really marked the start of this year, seemed to be the undoing story. I mean, perhaps before that, there was a period of real consolidation up to from the 8,000.
Exactly, yeah, leading well into 15.
Yep, indeed. Just staying in the region, if we can, needs to remark on this. On a day for ANZ, in fairness, which we left out of the discussion, but just because we've taken viewers up to the region, you had a Google executive brought into the fold under Shane Elliott now, Mel Carnegie, to really run digital, in a sense that, and this really occurs at the same time as Citi has just sold its prize stake in China Guangfa Bank for $3 billion. So Citi is exiting its cornerstones holding in a Chinese banking entity, right? And it's almost kind of backing up, is it not, the retreat by ANZ and a renewed focus now on something perhaps more esoteric, but more resonating for people here on digital.
I think in the equity story, Citibank story has been they've been closing branches everywhere. It is the return on equity story. It is all about that. It is crystallising $3 billion, put it back in your balance sheet. That's one strategy. Has ANZ moved out of their Asia-only strategy? Time will tell. It is a very hard road to hoe when it is not your home base. Yeah. And I think that's part of the
beating forces, and it's not your domain.
And is that always going to be the retort, though? Because nothing will therefore change that, will it? There's got to be some.
Well, the market always view that the clients you get, the customers you get, are the customers that they didn't want, the locals didn't want. Yeah. And if you have, you do have offshore banks coming to Australia trying to win the BHP businesses, they're trying to win the Wesfarmers. You have that happening. That is alive, and they struggle to get through because of the relationships, the services, the history. Yeah. So common sense says that is going to be a hard thing to do, even if it is the biggest growing centre, and maybe you should have a crack at it. It's just a function of how you have a crack at it. And I think all banks are looking at how they take parts of their business, not all of their business.
And as headcount gets cut, and certainly resources and revenues get cut, then they've got to be more strategic of where they align or where they employ that capital,
so
both human and financial.
Yeah.
The deal I showed you there just then, it's the NAB took a local customer to buy a US property, cost $1 billion. We organised the funding through global funders, and we took our client. The return on equity is fantastic. The client's got exposure to the rest of the world. That's the sort of business that you want to do. Because if you're going to Asia, I guess, I'm not running ANZ. If you're going to Asia and winning the Asian client set, that's one. But if you were taking our clients to Asia, that's a different deal.
Yeah.
And I think that deal makes a lot of sense when you're saying, let's understand the pathways there, let's build some franchises there, and then let's take you to the rest of the world. That's sort of where you are sticking to your knitting in terms of servicing the customer and then broadening the customer's market opportunity. Sort of
and
sense.
hoping the two mesh. Well, yes, and believing with the best of intentions they do mesh.
Well, I've got a contract. I've got a contract in the one, so I need somebody to do the foreign exchange for me. Yep, exactly. I can do that. Those sorts of engagements. I need you to be taking receivables in one country, paying them out in another jurisdiction. Yes, we can do all those sorts of things. I think that's the function that you need to be looking at.
And remember, if it's in Indonesia, if you start getting it in writing, that means you didn't trust them over the phone. It's all rather interesting, the whole cultural sort of breakdown at play. So different. Let's take a break. When we come back, though, we will be talking to Beijing. So, right, well, you're getting the real Asian hit this afternoon. We'll be back after this with Tom Orlick from Bloomberg. Welcome back into the programme. China now, another slip in the data releases on manufacturing. This one, activity falling more than expected in February. Official Purchasing Managers Index coming in at 49 points. That's down from the previous month's read of 49.4. The lowest read now since November 2011, the 7th straight month of contraction. Well, the private-run Caixin survey, that's more the SME part of the economy. That's fallen to 48 points from January's 48.4. Both, of course, under 50, so telling you things are tough. They're contracting and raising doubts on the government's ability to cut industry overcapacity without triggering that sharp rise in unemployment that could destabilise the very party's structure itself and its future. Well, the factory sector under pressure from weaker demand, oversupply in key industries, including steel and coal. 1.5 million workers in those sectors were laid off, just like that. Told, nice knowing you, but not in this factory from tomorrow, thank you. Tom Orlick from Bloomberg Intelligence, live from Bloomberg in Beijing. Welcome into the programme. Again, with a pen stroke, that is done, and we just accept it, Tom. But peer through the numbers. Talk to me about real economy territory. What you see beyond simply a very bland release on manufacturing, because after all, this is an economy that's trying desperately to move off that drip feed of a growth support into service. Is it achieving it?
So I think there's definitely a positive story to be told on the transition from manufacturing to services. Manufacturing sector, factory sector, as you mentioned, continuing to contract in February. Slightly better story from the services sector. Services sector, China's hairdressers, accountants, software engineers, they're continuing to see expansion in their business. I think the big question really is, who's going to win? Is the negativity from the factory sector going to drag the services sector down? Or are rising incomes going to give the service sector more demand and give it some escape velocity?
Well, time horizons, when might we be in a better position to know an answer on that?
So it's really a critical time for China's policymakers. We're coming up to the National People's Congress on Saturday. Premier Li Keqiang is going to give his report on the work of the last year, set the agenda for the year ahead. We're going to get the final version of China's 13th five-year plan, their blueprint for managing reform and growth over the next 5 years. So I think the answer to your question is pretty soon.
Tom, Mark Dodd here from the NAB. I am curious about the balance of the two segments that you talked about of their economy, so the services, hairdressers and Atal, and the manufacturing. In terms of size, how would you describe them? You know, which is the larger, or are they now more balanced, or is it still one is a minnow being the services and the manufacturing still the behemoth?
So, you know, another positive aspect story we can tell about China's economy in the last few years is that it used to be an industrial manufacturing economy. And of course, industry, steel, cement, still very important, but services are now larger. Services have now overtaken manufacturing as the larger component of China's economy. And that's why we can talk about that positive dynamic. Services sector drives more employment means higher incomes means more demand for services. So there's a lot of bad news out there on China's economy, and we're not, you know, 100% confident on the outlook. But if you look at that bigger reform story, there is a positive story to be told about the self-sustaining positive dynamic in the services sector.
As a one-party country, I assume that one of their themes is to maintain that one-party status. So in that respect, you're looking for social, you know, disharmony. What's the view on the environmental outlook for China at the moment? Do the populace see inroads around the fact that air quality is improving? There's been attempts by the country to improve the quality of life?
So China's leaders have definitely made environmental cleanup, environmental sustainability a big priority. There have been big protests around the country, around specific incidents, polluting factories and so on. If you talk to people on the streets of Beijing, it's very clear that air quality is probably their #1 priority. So last year, Premier Li Keqiang called the smog China's flashing red, called it Mother Nature's flashing red warning light. Actually, through the smog, it looked kind of more orange to me. But I think that was an indicator that the government is taking those concerns seriously, and we are seeing some concrete steps. In Beijing in the last year, they closed all of the coal-fired power plants. We're not seeing, you know, it's not like the Swiss Alps in Beijing today, but it's a little bit better than it was a year ago.
I just want to also flag this running saw, which is, you talk about that, you know, we're trying to do this, we're trying to do that as part of the shift into services and the middle class and the growth of the middle class and the sustaining of that transition. The Caixin release and the employment sub-index there, you can't put lipstick on a pig here. This is not a Lunar New Year blip. This is actually quite some concerning trend, is it not, emerging? That there's not in the SME space a buoyancy about these numbers. Far from it.
Yeah, absolutely. There was some worrying aspects to these numbers. The worst employment reading on the Caixin PMI since the beginning of 2009. That's not a pig which just needs lipstick. It needs an entire makeup team working on it.
Yeah.
At the same time, the manufacturing sector is not now the most important sector of the economy, and the service sector is more labour intensive. You need more hairdressers to create a unit of output than you'd need workers in a steel factory to create a unit of output. So even with slower growth, even with a shrinking manufacturing sector, the larger role for the services sector does seem to be creating a buffer against widespread unemployment.
So really, increasingly, you start to relegate this release to second-tier status at best, right? In the pantheon of what matters most.
No, I think it's important. We had a huge amount of stimulus coming through in 2015. The expectation from all of the analysts on the street, our expectation was that that stimulus was going to start gaining traction and that we'd start seeing some firmer numbers coming out of the manufacturing sector at the start of 2016. You mentioned the seasonal effects. Yes, there are seasonal effects. It was Chinese New Year, week-long holiday in February, so it's difficult to really make clear judgments about the trend, but these are not good numbers, and if we see more negative numbers in March and April, that's going to ring some serious alarm bells, suggest that China's got too big a debt problem, and that even as the government cuts interest rates, that stimulus just isn't gaining any traction.
Do you think, Tom, that the banks will move forward with the lowering of rate down to 17% for the cash at hold? Do you think that will stimulate banks to lend to individuals, or do you think individuals aren't really borrowing? They just don't have the confidence to want to go out and borrow as borrowers now?
You know, we saw 3.4 trillion yuan in new credit going into the economy in January. That was a record number. Now, maybe there were some seasonal effects in there as well, but a record lending number suggests there is credit demand in China's economy. Zhou Xiaochuan, the central bank governor, was out last week. He was talking about how China needed to make more mortgage loans. So my anticipation is, yes, they've got a big problem with the credit bubble. Yes, in the next few years, they're going to have to start managing that down. But for 2016, we are going to see continued robust loan growth, precisely because the government is concerned about the kind of weakness that we're seeing in today's PMI numbers.
Tom, do you think that'll support property prices first off, and secondly, of course, the equity markets?
So the equity markets, I think, is going to be a case of once bitten, twice shy. China's household investors really got burned in the equity markets in 2015. I think it's going to take a while for them to be confident enough to come back into the markets. I'd be surprised if we saw a very strong equity rebound in 2015. Property, in 2016, sorry. Property, I think potentially on prices, there's already a positive story unfolding, at least in top-tier cities. Beijing, Shanghai, Guangdong, we're already seeing prices rising pretty quickly. The difficult question for the government is this going to be a bubble in prices with no pass-through to construction, or are we going to see developers going back to building? Because it's only if we see developers going back to building that we have stronger demand for steel and cement, and we get China's factory sector moving again.
Tom, when we think of China and their reserves, their US dollar reserves are obviously enormous, and they've been spending some of those reserves to protect their currency. We've here spoken about the fact that the change in politics in the US might mean there's a Trump Republican standing, or at least potentially a presidency. How do you think the US will start? How do you think China will start viewing the US as the safe haven that it once was, or still is? How do you think that relationship starts to play out?
You know, I think the US presidential election cycle, it's been commanding a lot of media attention. So far, I don't think it's been commanding a lot of international or market attention. I think as we move forward and we move closer to the Republican nomination, that's going to start to change. And so those kind of bigger global macro factors, like China's investment in the United States, are going to start becoming more and more important.
The other concern, and it touches on a theme familiar to many Australians, this idea of who speaks for what part of the bits and bobs that make up key institutions in China, like the PBOC. So you've touched on the governor there, but of course we forget that it's also got the function of macro-prudential oversight. Unlike in Australia, where that's broken up, it's given to another institution. Is that in serious need of, as these loans only mount, as you cater for that increasing middle class, do we need some break from that very, I suppose, centrist and conflicted method of operating, both stimulant and overseer?
Yeah, I mean, it's certainly a centralized decision-making process. That does have advantages. Remember how effectively they responded to the slowdown in growth at the end of 2008 and 2009. I think in many ways that stimulus response, the effectiveness of that stimulus response was the envy of the world. Clearly, it also has costs. Where there are conflicting priorities, sometimes some interests are not heard. 2016, if we see weakness in growth and the need for an effective stimulus response, maybe actually will be grateful for the kind of unified, centralized decision-making process which allows China to respond to that kind of slowdown so effectively.
Well, it would just be nice if they then gave the governor a seat at the Politburo itself, would it not? Just, you know, to reinforce it and not maybe give the lie to it. But that's, again, conjecture. Tom, thank you as always. Bloomberg Intelligence, Tom Orlick there, prolific and on the money from Beijing. So, yeah, lots we can mull on that one.
Of course.
As you were saying before, just this hopefully slow and steady wins the race and march towards reform. But again, even and it was David Engels who was saying this idea of will it be enough? Even when they come back, exactly. Even last year, all through last year, the sense that they were baby steps. There was not the conviction.
They need to get the developers. They need to, as far as from a supply side, as far from building, you need, and naturally they're trying to stimulate it to get the retail investors to take on board. China's in a dilemma in so many ways, but I still believe in the story. But at the present time, we're going through a minor hiccup. And I think over the long run, I'm fairly confident that things will work out. But it's going to be, I think, a rocky road for a couple of months.
And FDI must therefore remain a key metric that you watch. Just the idea of the inflows, the outflows. Where are they going?
I mean, I think I would agree that you'd assume that China, 10 years from now, you could have the China Buffett equivalent saying, just don't go against China, just back them. And I completely get that. How as an investor you take advantage of that, I don't know. I just think that they will march to their own beat because they're looking to evolve and they haven't yet got their own plan. It'll be the 13th five-year plan. It might be the one that's more attuned to the rest of the world engagement because the rest of the world is still at a loss. Remember, Morgan Stanley were going to have an index where the Chinese equities will be part of the global index. And then they decided at the last minute they wouldn't do it, and that equity market was absolutely smashed.
Yeah. Well, just on that decision.
Yeah. Well, they just looked at it and said, "Well, there's just not enough transparency. We just don't get it yet."
Yeah.
You know, state-owned enterprises being listed, small amount of listings, moving the share price wherever you see fit. It is too challenging to work it out.
Transparency.
Yep. Well, yeah, and the need for it. OK, let's take a break. We're back, though, in just a tick to summarise where we've been and as well just kind of do a look ahead, crucially, into what's in store for you tomorrow. Stay with us. Final thoughts, look ahead as well, because we are just a smidgen through really what's a jam-packed week of data. We'll finish Friday, to all intents and purposes, with that Big Bertha release out of the US.
Non-farm.
I mean, sub 5%. You know, we should be doffing our caps in many respects.
Exactly, 4 8s, 4 9s, yeah.
Admittedly, though, this will not swing the Fed, will it? Just, even if it doesn't measure up, it's not going to be
I don't think you're going to get it. Certainly not. I think, I'm more to the point, if you are going to see a rise, you may be looking in June. Let's see what happens over the next couple of months. You've got a lot of things happening in the States.
And, I mean...
I agree. I think the Fed will talk about this transition from Wall Street to Main Street. That will be front and centre. So I think if they get a good non-farm, they'll still say, we're still waiting to see about them. So that won't force their hand higher. They will say... Looking at global volatility,
energy prices,
if that transitions into Main Street from Wall Street. Lots of volatility in Wall Street. Let's see what happens.
And where's the US dollar? Where's the Dow? What's going on? Is it marching back towards an S&P with stronger numbers, or are we going to see a sideways to a weakness over the next 90 days?
What's your kind of gut tell you on that measure?
Gee, it's a hard one. I think there's just going to be just volatility. I think it's hard to put a number. It's hard to, you've got to say what day will it be at what price, because there are too many unknowns feeding into that. You've got a recovery and people will say, oh yeah, all of a sudden we've seen energy markets up and it's at $35. Are we at 45 by May or June, or are we still at $35?
Because it remains in bear market territory, though, like it or not, even on that bounce. It's still a bear market bounce.
Of course.
Yeah, absolutely. And the challenge is oil the problem or is it a benefit? Because oil being so low, US is a consumer of oil. They make a little bit of their own, but basically, why is it not a positive story? Yeah. And I think they need to address that. Why is the world economy seeing this as a negative when it should be, theoretically, hurts the Saudis, hurts the Russians, hurts the Venezuelans? Yeah. Okay.
For mum and dad, great for the wallet, great for the purse, and more spending power for the main street.
Last I looked at the US wasn't worried about those countries too much. I mean, they're, certainly Venezuela, Russia, maybe Saudis.
So that's why it's hard to pick a headline number for the S&P, hard to pick where the rates are going, and hard to say, well, where's the Dow and what's going on, because of when you feed in all of those variables, and they are very, very large variables, it's hard to put an assumption there to say, right, that's going to be it.
Totally. It's very seductive to say, more power to the consumer as far as cheaper prices. Those prices have been on skid row for manufacturers in the United States for years now. The for sale signs are bolted onto the windows. They're not stuck on. They're bolted and screwed in because they never take them down. Yeah. And those margins have just, who would be in business?
But
come on.
The thing that will...
Lower energy didn't give you that.
I mentioned this at the start of the show. The US, last month, $100 billion in fixed income. Exxon was a big issuer yesterday. So I think it was $32 billion. Same size as Apple. 9 tranches. So I'm saying, wow, people are lending to these companies. They see faith that they can get their money back. So is it the equity story or is it the debt story? To some extent, $100 billion in February seems like it's the debt story, where I'm not sure about your economic story. You've got the for sale signs up. I'm not 100% certain, but I look at where your cash is, I look at the cash you're generating, I'll lend you a bit of money. Yep. And that's what's happening. They're lending money.
At high yield.
Yep. They're going to the more conservative outcome, saying, let me lend rather than having to buy into all of it, because cash is really hurting.
And if you look at Exxon as a test case there, and that's your case study, so you say, right, at $30 a barrel, what happens if it's at 50? Yeah. It's going to provide and it's going to generate so much more cash. It's a safer bet, and that all talks into why the dollars are
and yet the lion's share of its revenues are coming ex-North America. So actually, it's not necessarily a commentary, though, is it, on the buoyancy of America the brave, America, as Warren Buffett said this week, the kind of champion against all odds.
Charles Schwab borrowed $250 million yesterday. Now that's America. That is equity story. That is so to run their business. They went out to US investors and said, "Give me $250 million," and they gave it to them. So I think of it that way around. Okay, that's a street stall. That is Charles Schwab's everywhere.
Exactly.
So it's one of those things that I think people are getting more conservative and saying, "Give me a debt outcome." We had that chap saying Japan said, Mr. Rennie said Japan was viewed US as a high yield country.
Well, it is when you look at Europe and you look at Japan.
Context, so you can see a lot of people saying, I know Exxon, you're going to give me a spread over treasuries, let me just lend to you. And it'll be global investors. It won't just be the local people. It's everyone.
And are they the Mrs. Watanabes? Are they the people that are borrowing cheaply in the Japans and the Eurozones and flooding that market?
And those questions have to be answered in the next show because we've crashed the pips. Gentlemen, thank you. Pete McGuire from xm.com.au, the CEO no less, and to you, Mark Todd from the NAB as always. Thanking you both. We'll see you in a week's time.
My pleasure.
Thank you, Carson. Thank you, Mark.
To your company there.